The market drops 10%. Is that a problem or just part of the process? Volatility may be uncomfortable, but it's not your biggest threat. Today, we're going to break down the 7 real risks that could damage your retirement income plan. More importantly, we're going to talk about how to avoid them.
Back for another episode of Your Retirement Elevated. Walter Stroholt alongside financial advisor Scott Dugan of Elevated Retirement Group, helping folks plan for their finances all across the country, based out of the Kansas City area. And can't wait to dive into today's episode, Scott, because we're talking about real risks, but I like how you ended the tease, how to avoid them, because that's what everybody really wants to know. Before we dive into those 7 different things that we're going to cover on today's episode, I feel like we'd need that better understanding of what risk really is and why people often get it confused with volatility. I don't know, they're close cousins or something, right?
Yeah, and I think people think they're interchangeable. And I think my industry has a lot to do with that, because we do a risk profile, give a risk score, but what we're really trying to discover is what's your comfort level with the ups and downs of the value of your money. And because volatility is just the normal price fluctuations over the short term. And so what we're seeing right now is short-term price fluctuations. And it's because we're in this tariff situation, and that really pricing in. Our chief economist, Tom Siamatis, he just did an event for some of our clients here in Kansas City. And he said, they priced and he thought that was about a 5% drawdown because of the tariffs. The rest of it is more panic and emotional things. So again, that short-term volatility, there's uncertainty. We're not sure, what's this going to mean to the overall global trade? And it's very hard to price that in. Now we're seeing some bright spots. Even as we're recording this, I was just reading, China has lifted tariffs quietly on semiconductors and a few other things. And so they're making some inroads, but again, I don't know that we're out of the woods yet, but again, we're going to see volatility. And so again, that's just the price change short term. Risk is the real risk we're concerned about as retirees is we're not going to meet our long-term goals. We're not going to be able to continue our lifestyle to and through retirement. And so again, risk is not temporary ups and downs. It's the permanent loss of your capital. Like that's an Enron type of thing. And so risk is any decision that reduces the probability of achieving your goals. And so I know we've talked about it, Walter, you're out in Colorado doing a lot of hiking. Volatility is just the ups and downs of the trail.
Yeah.
That's normal as you're getting to the top. As long as you can still get to the top and work your way down safely, there's going to be ups and downs. Risk is falling off the side of the mountain. You're not continuing. That's what it is. And so again, is there risk in volatility? Is there risk in a recession? It's potentially a setback, but I don't think it's a catastrophic thing for most retirees out there.
Especially if you're viewing things from like a long term, right? Like there's volatility risk, the risk of the ups and downs in the short term, but it seems like that risk diminishes the longer our horizon is.
Correct.
Okay.
That is certainly correct.
Well, I know that you love Nick Murray, so I thought I'd bring a Nick Murray quote to the table for you to set the stage. And it's volatility is the price you pay for returns. It is not the cost of failure. I thought that would be something you'd enjoy.
Oh, absolutely. And if you think about volatility, where we've talked about it in previous shows, where we're seeing volatility, like we had an 8.5% up day in the last 30 days. Okay. So we're down 5, up 8.5, and that's all on news headlines and reporting. So because the real threat, that Nick Murray talks a lot about this, is the real threat is our behavior, is our reaction. The market isn't the problem. Emotional decisions are the issue. And that's where selling low or abandoning your plan causes real lasting damage. And I can tell you, I've been doing this for, I say, almost 25 years. I can tell you there's people that I met post 2008 that, they've got out, halfway, because it started in 2008, ended in March of 2009, but just kind of threw up their hands in the latter part of 2008 and said, I'm out. I can't handle this anymore. And I've talked to people that never got back in. And so they locked all those losses. They missed a 4x, return in the market after that, and I had clients, conversations during COVID. Oh, this time it's different. Should we do something different? No, let's stay the course. We've got a solid plan in place. If we're going to be off track a little bit because the market's not cooperating, we've got enough in that war chest to be able to make it through. So again, markets don't hurt people. What people do in reaction to markets, that's what can hurt people.
Yeah, and that's where we've got to be super careful. So let's run through the 7 real risks to your retirement plan. First is that market risk, and this one's obvious to, I think, everybody, right?
Yeah, definitely. Is that broad declines, in economic or global events? Obviously we saw that during COVID. We saw that in 2008. We saw that in 2001, 2023. That's where diversification, it definitely helps mitigate that. And it doesn't eliminate the exposure to it, but it can help soften that blow a little bit. But I think that number one, market risk. Number two is probably one of the biggest risks people maybe aren't prepared for or really haven't comprehended or haven't been explained to them. And that is sequence of returns risk. And that is really, when you retire, we can't choose what types of returns we're going to get. And if you think about 2000 to 2010, basically, that was called the lost decade. And so you think about retiring in 2000, you had an agonizing 01, 02, 03, climbed its way back. 08 happened, climbed its way back. I mean, that was a rough sled, going through that period of time. So if we're going to need to withdraw during our retirement years, we're withdrawing in a down market early in retirement can permanently impair your portfolio if you're not set up correctly. This is a great analysis from BlackRock. People talk about average returns, and there's vastly different outcomes depending on what phase of retirement you're in. And so this next visual that we'll go through from BlackRock. So this is an example of before retirement. And it's comparing really 3 portfolios. And average returns matter more than the sequence here. And so if you look at portfolio A, starting at age 40 with $1 million and going out to age 65, so those are your working years. And so at the end of that, you end up with $5.4 million. And so you've got good returns out of the gate. And the portfolio B is just an average of 7% per year. So just a steady return every year. Now, we all know that doesn't happen, right? We don't get a steady every year, but we end up at the same end result, 5.4.
Interesting to see it nonetheless. Yeah.
It is. Now, portfolio C is simply taking portfolio A and flipping the returns, and they're in a reverse order, but we still get to the same endpoint. They all average 7% per year. They all end up at $5.4 million. Now, when you go from accumulation like this to distribution, which is living off of your money, your sequence can make a huge difference. And so this example, if we roll into age 65 retirement at $1 million, and we're pulling money out for expenses, portfolio A, get out to over age 90, you've got $1.1 million. Not bad. You start with $1 million, take money out over time, you end up with $1.1 million. Well, portfolio B is just that consistent 7% rate of return. Again, that doesn't exist right now, but you end up with, less than $500,000. Portfolio C is just, again, flipping the returns from A, just reversing them. You run out of money in, late 80s. And so again, vastly different outcome with the same average rate of return. It's just the sequence that you got these was different. And so again, we can't choose what the returns are going to be, but we can choose to have a smart place to take our money from during volatile times. And so this is what people are concerned about. They're concerned about, do I get a bad roll of the dice and in my beginning parts of my retirement, and is our lifestyle going to be altered, and are we not going to be able to do the things we want to do? That's what people are concerned about. So this is a legitimate risk people need to be aware of.
Is your retirement strategy working as hard as you are? Get the answers you deserve with Elevated Retirement Group's information-packed toolkit. Inside, you'll get Scott's book, Exceptional Retirement, along with essential insights covering the 5 key areas of retirement planning, strategies to keep more of your hard-earned money, and how to choose your winning retirement team. Take control of your retirement today. Click the link in today's show description to claim your toolkit at no cost to you.
Yeah, 2 things. It's so interesting because you would think that the math would math the same on the way down. And it's kind of a similar concept, like the dollar cost averaging would be the reflection of this kind of on the other side. It's a good thing, kind of on the front end of retirement, but then it becomes a risk and a liability on the back end. And
Definitely.
This illustrates that beautifully.
Yeah, to your point, when you're saving, you're in that accumulation phase, you're dollar cost averaging into the market. When you're in retirement and you need cash flow, you're reverse dollar cost averaging out of the market. So if you need X amount of dollars per month and your shares are down, you've got to sell more shares to fill the income gap. Well, those shares will never be there to rebound. And so that becomes the issue if you got a bad sequence of returns early in retirement.
So in the same market to somebody who's 25 and dollar cost averaging into the market, they're in great shape. Someone that's 65 or older in retirement having to take a withdrawal on the same day at the same time is then having a very different reaction to what's going on. That's interesting.
Absolutely.
Just in case folks are wondering as they watch and listen to us talk about this, the fine prints might be pretty small on some people's screens. This is assuming a $60,000 a year withdrawal rate, and they did increase that each year a little bit for inflation. So just thought that was interesting to see where if you did live in a magical world where you had the 7% return, that 0.4 left at age, 90 or so, like that doesn't feel too bad. Like that'd be a great world if we could make it happen that way, right?
Yeah, exactly.
All right. Well, that is definitely a big, big risk, a sequence of returns. And you're right. So many people overlook at it. Unfortunately, we can't just end the episode there. There's 5 other real risks we've got to get to, Scott. And inflation risk is the next one.
Definitely. And again, inflation, we've seen higher inflation as of late, in the past few years. Rising costs quietly erode your standard of living. And you've got to make sure your portfolio grows fast enough to keep up with inflation, to really keep your purchasing power intact, and also the cost of taxes. So again, inflation is just one of those, another word for saying affecting your standard of living, affecting your lifestyle. And we need our portfolio to keep up with our lifestyle because people don't want to go backwards when it comes to that. So that's inflation. You've got to make sure that your plan can handle it.
Yeah, we've learned a lot about that one over the last couple of years, as have we on the next one, interest rate risk.
Yes. And so there's an example where for most of my career, we had declining or low interest rates. The past few years, we've had increasing rates, and now we're coming back down. We hit a high, I believe in 2024. And the big question right now is, are we going to see rates lower, or are we going to see inflationary issues where rates go higher? That's to be seen. And so again, depending on where you stand, higher interest rates are great if you're a saver, right? If you can get a 5% CD, which you used to be able to, that you're like, oh, well, that's not too bad. I like that idea. But if we get back down to the, 2s and 3s, then it's not so great to be a saver. It's great to be a borrower. People, if you're borrowing money, you want interest rates to be low. If you're a saver, you want it to be higher. And so there's going to be some equilibrium at some point. And at lower rates right now would help stimulate the real estate markets. It would help with the rolling over of federal debt that we owe the world. And so lower rates would be potentially a good thing for that. It also would probably stimulate the markets. Again, we're going to have to see what transpires here in the coming months and years.
Yeah, that would be one to keep an eye on for sure and what role it plays. We then get to longevity risk. This one changes a little bit because it's not so much what's happening to the external world, but what's happening to us.
Absolutely. And if you think about when we do our educational events at colleges, if you're 40 and you've got a target of 65 retirement, you've got something to work towards, right? You've got to, hey, I've got 25 years to get it together. Well, if you retire at 65, how long does your money have to last? Is it 10 years, 20 years, 30 years?
Don't know.
Nobody knows.
Yeah.
And so that's where that anxiety or unpredictability comes into play. And so the longer we are retired and living off of our portfolio, we expose ourselves to what? Volatility or ups and downs in the markets, where market sell-offs, potential recessions, interest rate changes, tax policy changes, health concerns. So the longer that period of time, the more apt we're going to experience these different cycles. And so again, they just compound those risks over time.
You're making me anxious, Scott. You're saying like all these things are big risks every year, and then if you live 30 or 40 years in retirement, well, just multiply all that by 30 or 40.
You're just gonna, because everything cycles through, and you're just gonna experience more of those. And talking to a client about my grandfather passed away. He's almost 100 years old. He retired at 62.
Yeah.
So 62 to almost 100 was his retirement.
Almost 40 years.
So think about all the things that he saw, during that period of time.
Yeah.
He had knees replaced, shoulder surgeries, eye surgeries, just all those things. He saw all times ups and downs in the markets. Now, my grandparents were fortunate. They had a lot of guaranteed checks coming in, through pensions, Social Security. They didn't need a lot of savings. They didn't have any debt. So they were relatively unaffected by the ups and downs of the market. And they got cost of living increases on a lot of those paychecks. So as long as they kept kind of an emergency fund and every month they had a little left over and they saved, they weren't exposed to a lot of these things because they had a solid plan, but it was all based on guaranteed income. And for a lot of retirees today, two Social Security checks potentially, for a couple, but they're in charge of saving a nest egg that can produce a predictable income to supplement. And if we don't know how big that balance needs to be, if we don't know what rate of return that we need to get, if we don't know how to factor in taxes, that's where all this gets fuzzy and we get anxiety, and then we don't pull the trigger and we don't retire, or we react to the headlines because we haven't sat down and had someone guide you through a process to check all the boxes, cross all the T's, dot all the I's, to make sure we really have investigated all 5 areas and you're solid in all 5 of those critical areas.
Yeah, fantastic points. We've got 2 more to get to here, Scott. Liquidity risk is our 6th rule of real risk of retirement planning. What's the big deal here?
The average American, doesn't have $1,000 saved for emergencies. That's the scary thing. And so not having cash available when you need it can lead to forced selling of assets or borrowing at bad times, borrowing from a 401k, having to take a home equity line of credit because we don't have a savings or a nest egg out there. Now, we're very fortunate in our firm. We don't tend to see that. Our clients have been good savers, fiscally conservative, have an emergency fund, have a very good nest egg. They're just wanting to focus on how do I turn this into a sustainable paycheck. And so liquidity is there. And our final and 7th one is that tax risk. Why do we have a CPA firm internally? Why do we do tax planning? Why do we do tax preparation? Because taxes are a matter of fact and investments are a matter of opinion. Taxes are black and white. There are rules there. And if we can save our clients 5, 10, 15, 20% in 1 year or year after year, that compounds, and that can be very meaningful. So again, without a tax smart strategy, you could end up paying more than necessary. Now, we want to be patriotic. We want to pay our fair share. We're not talking about anything nefarious. But again, the tax code, if you don't have a tax plan, the IRS provides you with one. You've got to be proactive and looking at what are the things that are available to you to implement in your situation. And you could have a poor withdrawal order, meaning, do you know when to take out of your checking account, out of your trust account, when to take money from your IRA or your Roth? How does that work? What's the order you're going to do that? Are you subjected to IRMA penalties? Are you making too much money where your Medicare is going to cost more for your Part B and Part D? Do you have capital gains exposure from phantom income tax? Do you own mutual funds in an after-tax account? And if you do, you can experience them selling at the end of the year, and you experiencing, getting a 1099 going, hey, I didn't even get any money. What happened here? And so that can be very common from a capital gains exposure. And required minimum distributions. Do you have an idea of what that is going to do? Do you know how much you're going to need to take in retirement? And what is that going to do to your tax situation? We had a prospective family referred to us from another client. And I said, have you guys looked at what your required distributions look like at age 73? Like, no, I don't think it's going to be that bad. But we've got a great pension and we've got a good Social Security check, 2 Social Security checks coming in. And that really floats our boat. We don't really need a lot of money for anything else. So we went through our process and pulled it up on the screen. And their RMDs at age 73 were over $100,000.
Oh, wow.
You're like, wait a minute, it's going to be $100,000? Says, yeah. And it's going to get bigger every year. And so they're going to be subject to IRMA almost throughout their entire retirement because of all the other things that they have, going on in their situation. Again, very sharp people just have never approached from the tax side. So again, taxes are a big deal. And so again, the keys of this, kind of a wrap up, is, volatility is part of the ride. Don't confuse it with risk or failure. It's just part of it. Now, we want to make sure you experience the amount of volatility you can handle and it's appropriate for your situation. And these 7 risks truly require your attention, and you've got to have a plan and have a good disciplined approach to handling all these. And as to end on another Nick Murray quote, I love this one. It says, the only meaningful financial risk is that you're going to outlive your money. And I can tell you, most of the people that come in, they're not concerned about inflation or tariffs or taxes. What they're concerned about is, are we going to be okay? Are we going to have enough money? Is our money going to last as long as we do? Is healthcare going to throw us a curveball? What does that do to our portfolio? Are we going to be able to continue to be independent throughout our life and continue to live the lifestyle we're accustomed to? That's what people are concerned about. That's what a solid, comprehensive plan will provide you, is direction all those. So if you want to know if your retirement income plan is built to handle all these risks, let's stress test it. Give us a call, contact us, come in. We'll walk through our complimentary discovery session where we're going to talk about those 5 areas, and we'll help assess how critically prepared are you on those 5 areas. And we'll let you know where you actually are really, there's a shining spot in your plan, where you may need to take a look at and tweak a few things, or if there's any red flags. That's what you would get in our discovery session. So again, give us a call, complimentary, no pressure. Just sit down and talk to me or one of our team members to walk you through that process.
You can book that discovery session very conveniently. Just check the links in the description of today's show. We've got it right there for you where you can schedule from your smartphone or computer. You can also call or visit the website listentoscott.com for more information as well. But if you want to go straight to booking that complimentary review of your plan and go through that discovery process with Scott and the team at Elevated Retirement Group, again, just click that link, whether you're listening on Apple Podcasts or Spotify or the website or YouTube. That link should be there for you in the description. So check that out. Scott, thanks for this great breakdown today and covering these risks, and we'll talk to you again next week.
Looking forward to it. Thanks, Walter.
Yeah, come back and join us. New podcasts every week right here on Your Retirement Elevated. We'll talk to you soon.
Are you on the path to retirement but feel uncertain about your direction? Don't let myths and misconceptions cloud your journey. Before stepping into a lengthy retirement, gain clarity and confidence with a complimentary financial review. Schedule a conversation with Scott Dugan. It's completely free. Just click the link in the description below or call us at 913-393-4724. Let's start a conversation about what's most important to you as you plan for a successful retirement.
This video has been prepared for educational and marketing purposes only. The information in this video is general in nature, does not constitute personalized investment advice, and does not provide a complete analysis of the subjects discussed. All investments involve risk, and different types of investments involve varying degrees of risk. There can be no assurance that any specific investment strategy will be profitable or suitable to you. Additionally, although information presented in this video is believed to be factual and up to date, we do not guarantee its accuracy. You should consult an attorney or tax professional regarding your specific legal or tax situation and should consult a professional advisor before implementing any of the strategies mentioned in this video. Investment advisory services are offered through Elevated Capital Advisors LLC, an SEC-registered investment advisor affiliated with Elevated Retirement Group LLC. Registration as an investment advisor does not constitute an endorsement of Elevated Capital Advisors LLC by securities regulators, nor does it indicate that the firm has attained a particular level of skill or ability. Insurance advice and products may be offered by a third-party insurance producer, which may be affiliated with Elevated Retirement Group LLC and Elevated Capital Advisors LLC. Walter Storholt and Third Wheel Media LLC receive compensation for their assistance in preparing and hosting this video.